So are we in a recession in 2022 or not? What a crazy month it's been. In this video, I'm going to talk about a 2022 recession, if it's here or not, and most importantly, how to prepare and profit from it. Okay, so first let's define what a recession is. A recession is defined as 2 consecutive quarters of negative GDP growth. And as of the end of July, we found out that indeed we have officially hit a recession. The second quarter advanced estimate came out this past Thursday, and the results are negative 0.9%. Now I know it's not like a huge surprise to most people, but what is surprising is how we can suddenly change the definition of a recession, which is what White House officials are trying to redefine right now. According to the White House Economic Research Team, those geniuses define a recession as a significant decline in economic activity that is spread across the economy and lasts for more than a few months. On top of that, the White House committee has even made it clear that they even reject the outdated definition of a recession. Well, so what does this all mean for the stock market, and what is the market predicting for the latter half of 2022? Hi, my name is Dan, and I talk about stocks, investing, finance, and anything to give you an edge to make a lot of money. If you find any of my content helpful, all I ask is for you to hit the like button or comment below with any of your thoughts. And yes, I really mean any. It can even be what you're thinking about today, randomly, like sea turtles. Okay, so anyways, so the government wants us to look at a number of other factors, including real GDP, real income, employment, industrial production, and wholesale retail sales. That's 4 additional economic data points the government wants us to look at. In 2022 this year, employment, or the amount of people working, has actually gone up. And this is good because the more people working, the more stuff we produce, and the better the economy will be doing. The second chart they want us to look at is real personal consumption expenditures, otherwise known as PCE. This is the Federal Reserve's way of measuring consumer spending. The PCE is more broad than a CPI, the more popular metric we know about, which is the Consumer Price Index. In 2022 this year, the consumer spending is going up, but now it's starting to cool down. CPI or PCE declines because consumers are spending less money, or they're not spending money at all because we're in a recession. Now, when people stop spending money, we're actually not stimulating the economy, which is a very bad thing. The third chart is real income, which, as you can see in the chart, has gone down this year. And that is definitely not good, because it means that although Americans are getting paid more, the reality is because of inflation, our real incomes have actually gone down. The last thing the government wants us to look at is industrial production, which has also gone up. Now, this is a good thing because that means we're making more stuff. So 2 out of 4 of these metrics are not doing as well as they should. And if we add in the GDP, which we found at the end of July is negative, then 3 out of 5 are not doing so well. But the government would argue that the PCE is just fine, so 3 out of 5 for them are doing pretty well. And it's completely understandable, because if you're a government official right now who might be afraid of losing your job, you would want to say the economy is doing just fine. So with all this in mind, why has the stock market been going up in the last couple weeks? Well, first of all, sometimes the market just doesn't really make sense, and then suddenly it will sell off the next day, which is why I never try to time the market. But the second reason the stock market is going up is because Federal Chairman Jerome Powell is doing exactly what the market was expecting him to do. The stock market usually does a pretty decent job of pricing in what they expect well before something actually happens. The stock market makes a forward prediction, and anytime it ends up being right, the market goes up. If it ends up being wrong, or something happens out of what was expected, it goes down, because the market does not like uncertainty. The stock market has already made its next prediction, and here's what it is. But before we get into that, I want to thank the sponsor of today's video, and where I get a lot of the information I find myself: Seeking Alpha. Seeking Alpha puts together hundreds of helpful articles and analyst predictions on various stocks and companies. They do a really good job of giving stock ratings while putting out great information on how the economy is affecting each and every public company. You can sign up in the link below for up to $200 off their premium subscription. Okay, so right now the market is predicting a 75% chance that the federal fund rate will be between 2.75 and 3%. But between now and the next interest rate increase, there are going to be 2 more inflation reports, and a lot can change between now and then. The first report is on August 10th for the July inflation, and the next report is on September 13th for August's inflation. If we find out that in either of those reports that inflation is 9.1% or above, we can assume that Jerome Powell will increase the federal fund rate by at least 0.75 basis points. 9.1% was what was in the last inflation report for June, and now what he's looking for is an inflection point when we've reached a peak. But as of right now, we actually have no idea how high inflation will actually go because it's still going up. Now, if inflation is anything lower than 9.1%, Jerome Powell might increase the federal fund rate by only 0.5%, in which case the market could go in either direction. Either way, what the market does not want to see is the federal government not increasing the interest rates at all. So here are my personal thoughts. In the first half of this year, tons of job openings are still out there. And even though wage growth is actually negative when compared to inflation, to me this doesn't look as bad of a recession like the one we had in 2008 or the early 1900s. Now I know there are plenty of jobs still out there, and even though life is still becoming more expensive because gas is still out the wazoo and inflation is still going up, a number of other catalysts can also help the economy and drive the market up. The biggest being if there's some sort of closing to the Russia-Ukraine war. If you're holding cash, I would start deploying some. If you're a beginner, I would just dollar cost average into ETFs like a Vanguard VTI, VOO, or VUG, so you have a healthy mix of growth, tech, and industrial companies. If you've been investing for some time, I would definitely consider selling options, specifically considering selling puts if you have a medium to larger account. Remember, you only want to sell puts on stock you actually want to own for long term, and long term being 3 to 5 years. Selling put options give you a discount on the stock if you're assigned, and you collect a premium. And if you're not assigned, you simply just collect the premium. If you're trying to grow a small account of $10,000 or less, I would consider trading put credit spreads, where you sell a put option and buy a put option with one strike below simultaneously. This strategy makes you a profit if the stock goes up or doesn't go down by a certain percentage. But keep in mind, you could potentially lose money on this trade if the stock doesn't go your way. Now, in terms of what stocks to trade or buy, that's really for you to decide and research, but personally, I really like Palantir, Meta, Google, AMD, Qualcomm, oil and gas, steel, any company with a strong balance sheet and still large prospects for whenever this economy sees the light at the end of this tunnel. Anyways, I hope you guys like this content. Again, make sure to hit the like button if you haven't already. I would really appreciate that. And comment below with any thoughts that you have. I'll personally respond to any comment about anything that you have. Thank you so much for watching, and we'll see you guys around in the next video.